Welcome to the Investing Insights podcast from Morningstar.com. This podcast is brought to you by the Morningstar channel for Roku. Enjoy insightful, independent video content in your living room. Download the Morningstar channel to your Roku today. This week on the podcast, Russ Kinnel gives his wrap-up of the Morningstar Investment Conference. Ariel's Melody Hobson says they are still finding value. Jeremy Grantham says U.S. stocks are pricey. Damien Conover shares a pharma pick. Russ Kinnel looks at the investor returns gap. And Preston Caldwell says oil prices are expected to fall. So let's get started. Here's Russ Kinnel with his wrap-up from the Morningstar Investment Conference.
Christine Benz from Morningstar.com. I'm here at the Morningstar Investment Conference where we're just wrapping up day 3, and I'm joined today by Russ Kinnel. He's Morningstar's Director of Manager Research. He's going to provide his perspective on the conference to date. Russ, thank you so much for being here.
Glad to be here.
Russ, we were all treated to quite a gloomy take on the world at the end of the day yesterday from Jeremy Grantham. Let's talk about that, your takeaways from his presentation.
My main takeaway is I would like there to be Prozac smoothies on hand when you leave Jeremy Grantham's speech. But it really was remarkable. We've heard him before talk about climate change, and he emphasized that again, where the climate change is coming. But he also pointed out all these other difficult things: rise in disease, decline in fertility, erosion of soil brought on by climate change. Really difficult. He talked about how there are investment themes based on that, such as renewable energy, but it certainly was a very gloomy speech. And I think one of the takeaways too is just we tend to lock into the present and the way things are now and think things will only change incrementally in the future. And when you hear someone say 40 years from now the world could be very different, it's kind of shocking, and that's hard to accept. But I think it's something you want to be open to, because that's the way the world really does work.
Just to stay adaptable. I thought it was interesting that in contrast with years past, where the focus of his presentation has been on investments and sort of what to be worried about in the investment market, this was a much broader discussion about what to be worried about in terms of our climate and in terms of the future of our world.
Yeah, I mean, it's hard to argue when you hear that 9 of the 10 hottest years in the history of Earth came in the last decade, and statistics like that, and you see the information on rising water levels and so many very hard to refute statistics, and you realize that's going to have a tremendous impact on our world and in our investments too. Yes. Obviously, the investments are secondary to the fate of the world, but it's still obviously that will impact a lot of businesses as well as our lives.
Okay. We just came out of a session with Diana Strandberg and David Hero, both great international value investors. I was really interested in their presentation. What were your main takeaways from it?
Yeah, I continue to feel great about investing with these two. Their funds are rated gold. We really like them. One of my takeaways was I really enjoyed them talking about the impact of Tencent. David Hero called it the greatest internet property out there, and they talked about owning it via Naspers, which owns a partial stake in it. But I also like to hear value managers who are really doing a lot of research on internet companies and tech, the FANGs in general, because I feel like the FANGs are really destroying a lot of companies in the value space. And you see a real difference between the successful value managers and those who are struggling. And I think it's the ones who really understand what the FANGs are doing are less likely to own those value traps. The ones who don't may be doing kind of reversion to the mean analysis, expecting things to snap back for these companies, but maybe they won't. The ones I worry about are these companies, the managers who are investing in old school media, advertising companies, and some others where you look and see, Google might eat their lunch, or in the case of a retailer, Amazon might eat their lunch. And you at least want the managers to really understand what are the real threats here, because I think that's going to be crucial for value managers to succeed.
So Diana Strandberg from Dodge & Cox and David Hero from Oakmark International, you think, do exemplify value managers who will be adaptable in the decades ahead?
Yeah, I think so. I think you see that in their portfolios today. They don't not a lot of obvious value traps in their portfolios, and obviously they're spending a lot of time understanding the dominant companies out there, as well as obviously China and how that's going to affect the companies they own.
Okay. You and the team at Morningstar spend a lot of time on manager evaluation and selection. You moderated a panel yesterday on that topic. Let's talk about some of the conclusions that you came away with. I think a lot of advisors who are looking at client portfolios have a little bit of a crisis of confidence in active management. How can people think about making smart decisions with respect to choosing and sticking with actively managed funds?
Yeah, and there's certainly a theme of, we heard from the panelists who were very focused on finding the areas where active has done the best, but I also talk about how they research active, and I think they really understand that doing the fundamental work, so not just looking at returns, but understanding the people in the funds, not just the managers, but the analysts, the traders. But I think the culture too. We heard Michelle Ward from MIM at Morningstar was talking about how she looks for firms whose goals are really long-term and aligned with her values and Morningstar's values. And I think that's really important. I see that is a significant difference, I think, from, say, experienced investment professionals versus individual investors, and even more some investment professionals who are new to the job, is they think more about stewardship and culture, because of the long run that really matters, and you really want to invest with the managers and the firms that really understand that, are really shareholder focused, really long-term focused.
One thing that came out in your session was PIMCO Total Return is kind of a case study in how investors manage through big changes at a giant fund like that, where we saw an exodus of assets from the fund in the wake of Bill Gross's departure. What came out of that discussion for you?
Oh yeah, I thought it was really interesting. All three of my panelists, all of them held on to PIMCO Total Return at a time when there was a mass exodus, one of the greatest exoduses in the history of the fund world. And they talked about how, yeah, we thought Gross was important, but we knew all of these managers and analysts, and PIMCO is a very deep team with tremendous experience, tremendous breadth, and a big trading desk. In the fixed income world, trading is really important, especially if you do derivatives as much as PIMCO does.
Right.
But they felt really confident that PIMCO still had all those important players, and they pointed out that that fund has done much better than most of the funds that people rushed into. So I think it really illustrates why there's a difference between what the general public sees and what some consultants and others who are investment professionals see. And one of those things is just all of the depth behind the manager. You know, for PIMCO Total Return, most commonly you would see Bill Gross on CNBC and not necessarily understand just how much was behind him. And really, we've seen since then that fund and the firm has really stabilized. The fund handled the outflows well, and you didn't see other people leaving to follow Bill Gross. In fact, I think if anything, analyst and manager turnover slowed down after Bill Gross's departure, which tells you something about the firm and Bill Gross.
Right, and Morningstar maintained a medalist rating on PIMCO Total Return even after Gross departed as well.
That's right. We had the fund rated gold. He left. We lowered it to bronze because we were concerned about how the team of new managers would mesh, whether people would leave, and what impact outflows would have. And over time, we've become more confident as we've seen everything stabilize. So we raised it to silver, and then more recently, we raised it back to gold.
Okay, Russ, thank you so much for being here to share your perceptions.
You're welcome.
Thanks for watching. I'm Christine Benz from Morningstar.com.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
Now, Ariel's Melody Hobson says they are still finding value.
I'm Laura Lutton. I'm here at the Morningstar Investment Conference with Melody Hobson, President of Ariel Investments. Thanks for joining us, Melody.
Thanks for having me.
Tell us a little bit about what you're seeing in the marketplace and relative to the stocks that you hold in the Ariel portfolios.
Well, certainly on the domestic equity side, we're finding value, which is probably a little shocking to most people because we're in such an extended run here. But even at this stage, we are finding things to buy. And we think a lot of it has to do with the commoditization of the market by the index funds, really, means that if you are orphaned, you are truly orphaned and creates a value for us to buy. So that's one thing we're seeing. The valuations on our portfolios are lower than that of our value indices, as well as the broad market. So we feel like we're insulated on the downside if the market does have a comeuppance, but we also feel that we have upside in the portfolio because of that valuation differential. Whenever we've been positioned like this, it has generally been a good thing for our funds and the returns that come thereafter. The overall market, we would say, obviously, this has been quite a run, and you never know what will quite undo it. These bull markets do not go on forever, even though we may think that they will. It will ultimately have its moment. But with that said, corporations are in pretty good financial shape. Their balance sheets were really cleaned up through the financial crisis. And I think that means that to the extent that we have some trouble ahead at any point, I think they'll be able to withstand it pretty well.
Okay. And what do you think the tax cut is fully priced in at this point, or is there room to go?
We do not believe the tax cut is fully priced in. We think the tax cut will still continue to surprise people on the upside. Analysts have been slow to adjust, somewhat because they haven't known exactly how it was going to affect all of the companies as things have been worked out. But I do think that part of the reason that we are seeing the market behave that it has is because I think this tax cut has provided more stimulus to companies and to the overall economy.
Okay, great. So just this week, Warren Buffett and Jamie Dimon came out with this call for companies to stop giving earnings guidance, that causes too much short-termism in the market. And you're a long-term investor, you're on the board of JP Morgan. Tell us a little bit about your view of that call.
It's so interesting because on the one hand, I think analysts like to have some kind of guideposts. You know, they like something to be able to direct their models to, et cetera. I think without guidance, it puts more onus on the analyst to do the work. And we're comfortable with that. So if there were no guidance, I think that we would continue to be able to distinguish ourselves from the marketplace and our peers by just doing the work. I do think the short-termism is something that is very problematic. It's something that very much concerns us. We have a turtle as a logo, and we talk about long-term patient investing, and the velocity of money has just sped up. The holding periods are so much shorter. It's whiplash. And I think as a result of that, they're shortchanging themselves in terms of the returns that they could be getting, but are missing out on because they're trading too much.
Well, but that gives you an advantage, right? If you're willing to be long-term.
It does. We literally tell people we play time arbitrage, and we take advantage of these dislocations by having a longer-term view. But I think there's a bigger issue here, and I think Buffett and Jamie Dimon are getting at it, which is bigger issue is, what is really being compromised? What kind of returns are really being compromised? And that could be a key to driving longer-term outlooks. And certainly, I think this quarter-to-quarter game that companies are playing is a losing game. When we go in to meet with management teams, we do not talk to them about quarterly results. We're talking to them about big picture results. What is your company going to look like 3-5 years from now, not 3 quarters from now? That means nothing to us. That's noise. And that's not how you make real money. Real money, as Buffett says, is made over time.
Got to be long-term oriented.
Exactly.
Thank you, Melody, for being here.
Thanks.
Can your portfolio weather the market? Use our premium portfolio tools to identify risks and streamline your holdings. Get started today with Morningstar Premium.
Next, Jeremy Grantham says U.S. stocks are pricey.
From the 30th Annual Morningstar Investment Conference in Chicago, I'm Jeff Patak, Global Director of Manager Research for Morningstar. I'm very pleased to be joined today by Jeremy Grantham. Jeremy is Chairman of the Board of GMO. Jeremy, welcome. Thank you again so much for participating in this year's Morningstar Investment Conference. I wanted to start off maybe getting you to update your views on a commentary that you published in January of this year, describing some of the necessary preconditions of a possible melt-up, a scenario in which the market would rally very, very sharply and then perhaps fall precipitously afterward. Given some of the activity that we've seen in the market in the ensuing 4 or 5 months, where do you stand now?
The easy part of that is the bubble collapsing. Historically, in order to get the market to have a really major decline, 50% in a couple of years, you've needed to have plenty of air in the pricing, psychological energy. You need people to buy into some fairly preposterous thinking. It's revealed from hindsight anyway. So in 99, people believe it's a new golden era of the internet. Greenspan described the internet as driving away the dark clouds of ignorance. 1929, you had the same kind of euphoria. Without euphoria and crazy faith, without perfect fundamentals and an extrapolation that they'll go on forever, it's very hard to get a rapid decline of the kind that we had in 1929 and 2000, and to some extent in the housing market of 07 and 08. And so that's the easy part. In other words, we're probably not going to have a rapid decline unless we have a blow-off. A blow-off needs twice the rate of acceleration as normal, maintained for a little less than 2 years, like 21 months. And in other cycles, that has produced enough oomph to be about 60% or more. And it looked like we could do that, and certainly by the end of January, it looked very promising. By the end of January, it was rising so fast that if it had covered another 10 points, another 10%, by the end of March, it would have been up 60 in the final 21 months. And that would have only been 3150 on the S&P. If it moves slowly, that 60% target moves on up. So if it takes full 9 months, it was 3,400. If it took 18 months from last December, it was 3,700. And the chances of that happening are not as good today as they were back in December, January. And the reason is that the uncertainty that's being produced by the administration on important issues like global trade has served to constantly rattle and make nervous the investors. Unusually, this is balanced, on the other hand, by strong profit margins, by rising profit margins, the highest globally they have ever been, by a synchronized, reasonable global economy. So you have some good data on one hand, and you have some nerve-wracking input on the other. This is quite unusual to create a kind of nervous balance. So 1% forward, 1% back, 2% forward, 2% back. And in that environment, it's anathema, in terms of a bubble. A bubble needs crazy euphoria. This is not the environment in which it can happen. Now, I haven't written my 50% chance down below 35 or 30 for the following reason. If the midterms make the market relax a bit, we also are entering the sweet spot of the presidential cycle. From October of this year through May of next year is an incredible period of 7 months, which has averaged about 17% a year since 1932, since FDR. And that is our last best chance of having a bubble melt up. And when that passes, I think time is not on our side, and we will not do that. So what will happen? Where do the probabilities go that I take away from a bubble and a bust? They move to a relatively historically unusual format, which is bumping along. So you go down 15 and up 10, you go down 17 and up 13. You come back in 5 years and the market is down 15 or 20%. Profits are maybe up 10 or 15. And the PE's close enough for government work. And everyone always likes to think that's going to happen. It very seldom does happen. The market likes to go up a lot or down a lot in real life. But I do think with this kind of creative tension that we have, we may be able to pull that off.
What's an investor to do, given that outlook? I know there's a great deal of uncertainties that attend to it.
From GMO's point of view, our first choice is a melt up, jump out, and have it melt down rapidly and jump back in. Our second choice is the bump along, because we are out of the US equities, we're overweighted emerging and EFA. And there's nothing in my 5-year forecast that says S&P down 20 to prevent emerging being up 20. It's easily cheap enough to have that sort of divergence with room to spare, and maybe EFA up 5. And that is a dismal market for a pension fund, but it's not a dismal market for GMO's relative performance.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Now Damien Conover shares a pharma pick.
When we look at the large pharmaceutical market right now, one of the companies we really like as being undervalued is Pfizer. Pfizer's, I think, going through a paradigm shift. If you think about the company many years ago, it was facing a lot of patent losses. And if you look at the company today, we look at the growth rate improving significantly. So the patent losses aren't going to be as significant. In tandem with this, Pfizer also has a great pipeline that's much stronger than it's been in many years, focused on oncology products, immunology products, products that carry very strong pricing power. And in the backdrop of this, the bottom line earnings we anticipate will continue to grow robustly to support a very strong dividend yield over the next several years. And from valuation, we think Pfizer's worth $43.50. And we base that on our discounted cash flow model, but we're also very cognizant of traditional multiples that are used in the big pharmaceutical landscape, which is the price to earnings ratio. And if we look at Pfizer right now, it's trading at about 12 times next year's earnings. And that's a big discount to the overall group that's closer to 15 times. Nevertheless, Pfizer has a similar growth rate. So we think Pfizer is very well positioned from a growth standpoint, and we continue to see the company with a strong, wide economic moat, really bolstered by that pipeline that is going after areas of unmet medical need.
Go from one investment analyst to 150. Sign up today for Morningstar Premium and let our independent and unbiased research staff help you find the best investments. Get started today with Morningstar Premium.
Next up, Russ Kinnel looks at the investor returns gap.
Hi, I'm Karen Wallace from Morningstar. The timing of investors' buys and sells can have a big impact on their investment performance. Joining me to discuss some current research on this topic is Russ Kinnel. He's the Director of Manager Research for Morningstar, and he's also the editor of Morningstar Fund Investor. Russ, thanks for being here.
Glad to be here.
So you recently updated your Mind the Gap study. This is an annual study that comes out, and what exactly are you looking at?
Right, so we're looking at investor returns versus total returns, which is essentially asset-weighted or dollar-weighted returns versus time-weighted returns. And as you said at the top, essentially it's telling you about investor timing. Is it good timing? If it's good timing, the gap will be small or even positive. If it's bad timing, it'll be negative, meaning they left some money on the table because they didn't make the most of their funds.
So you make a point in the piece to not put too much stock in an individual fund's investor returns, but when you look at it across a larger, sort of a broader category asset class, it tells a fuller picture.
Yeah, we really like to look at to see what's the typical investor doing, how are things working for them. But on an individual fund basis, there can be a fair amount of noise. So sometimes it tells you an interesting story, but you don't want to read too much into it.
Okay. So Russ, what are some of the big headlines, the big takeaways from this study?
Well, we're seeing the gap has really been shrinking over the last few years, and that trend's continued to where we have a small gap overall. And I think that's really because we've had a nice steady bull run. Mm-hmm. The gap tends to expand the most when you have dramatic pivot years. So years like 08, 09, where people are essentially selling on the way down and then they miss out on the rally. That's really bad for them. But the last decade almost entirely, the market's more or less been going up, and that's worked really well for investors. So whenever you have a relatively stable move in one direction, that works well for investor timing. And that's what we're seeing in the numbers.
So it's easier to hold on to a fund when it's steadily rising.
That's right. Investors do worse when returns trigger either fear or greed. Mm-hmm. But if it's sort of steadily rising, you kind of have a positive reinforcement mechanism.
Okay, that makes sense. So we saw sort of the gap in domestic equity funds overall decline. What are some of the things that you found there?
Yeah, so as you say, the gap is shrunk to where it's a fairly small gap, and that's really encouraging. And I think it's largely the story about equities just rallying and people making a lot of good use of their funds, really.
Mm-hmm. And balanced funds are an example of where investors have very good timing. They actually had a positive gap.
Right. So we see balanced funds. Every year we do this, we see really good results in balanced. And specifically where it's really good is the target date funds. And the reason I think is that partly target date funds are very stable, boring funds. They don't move a lot. They're super diversified. But on top of that, people hold them in a 401k. 401ks are vehicles where you're investing every paycheck. So really you have people are held to this steady discipline of investing regularly. And that's where you get the best results, because in downturns people are continuing to invest, and obviously you get more shares when in a downturn. And so we really see that works well. We've done the study globally. We see in other markets like Australia and South Korea, where you have something similar to a 401k, again, you see really good results there. So I think there's definitely something to that steady commitment of assets from investors.
Right. One surprise that you saw was municipal funds, which had the gap is shrinking, but it's still fairly significant.
That's right. The gap is over 100 basis points, which is really odd because if you look at muni bond returns, they're pretty steady, pretty boring. You don't see double-digit returns. When they lose money, it's usually a very small amount. So it's really unusual that such a boring space would have such a dramatic gap. But I think we've had a couple of events that have kind of thrown investors. Obviously, muni investors are very risk averse, so even a whiff of risk scares them. In this case, the last 10 years, we've had two events that scared people. One was the Puerto Rico crisis, and people withdrew a lot of money, even though most of the big funds out there had very little Puerto Rico exposure. So the muni market sold off, people got out, but really they were missing out on the fact that the rest of the muni market was really strong. The previous event was when Meredith Whitney went on 60 Minutes and predicted huge bankruptcies, which never came to pass. Again, people got out at the wrong time. So it's a little unusual, but it just speaks to how skittish the typical muni investor is.
Those headlines were enough to spook people.
And not a good time to sell.
Yeah. So finally, I wanted to touch on the alts category, which had sort of an interesting profile, that it had the worst investor return, but the best investor return gap. How did that work?
Yeah, well, essentially, we talked about how the gap is really telling you how people did at timing. And alts have done so poorly that really, if you sold anywhere over the last 10 years, it was probably a good move. And so essentially that's what it's showing, is that the typical alts investor got almost a 0% return, but the typical alts fund lost about 1% a year. And so we're seeing that the people actually did they did pretty good with their timing, but of course, those returns are not going to make people happy. The alts world clearly has to do better. Now, there's a caveat, and that is that the 10-year figures go back to a point in time when there were not a lot of alts funds. And so I think you have to take it with a bit of a grain of salt. But even if you look at more recent results, you see that alts returns have not been very good. And I think clearly the alts world is going to have to do better if they want to keep investors in.
So when we roll all of this data up and look at it holistically, what kinds of lessons can investors take away from this?
Yeah, so I think there are a few lessons. Some are about the kind of funds and some are about the kind of investors. I think when we look at it by data, we see that low-cost funds lead to better investor returns and better investor returns gaps, even by significantly more than the fees themselves. I think it's really smart investors finding good funds. We also find that low volatility funds work better for people. The really high volatility funds don't work so well. So low cost, low volatility funds work for people. And then the other part, I think, is just know yourself and know your funds. So know how much risk you can take, but also just go and look through funds' annual returns to see, are these numbers I can stomach? You know, you go back to 2008 and other times of crisis and look at a fund's individual calendar year returns, you might be surprised, because if you just look at the trailing returns, you might see an equity fund that's returned 9% a year and it looks great, but then you go and see, oh, but it actually lost 40% in 2008, so I have to be able to tolerate that to get to the good stuff.
Right. Well, this is really interesting research. Thanks so much for being here to share it.
You're welcome.
For Morningstar, I'm Karen Wallace. Thanks for watching.
No matter what part of the market you're targeting, Morningstar Premium Screeners are your shortcut to finding the best investments. Get started today with Morningstar Premium.
And finally, Preston Caldwell says oil prices are expected to fall.
Over the last several months, oil prices have steadily climbed upwards and now stand at about $66 per barrel WTI. This is above the Morningstar Energy team's long-term forecast of $55 per barrel WTI. Yet we think the factors causing oil prices to be elevated are merely temporary factors. The long-term factors which underpin our low-cost $55 per barrel oil price thesis remain as strong as ever and are substantiated by deep research our team has done. The factors propelling prices higher in the short term include geopolitical issues such as the collapse of Venezuelan oil production due to internal political and economic chaos, as well as anticipation of Iranian production falling due to the reimposition of sanctions by the Trump administration. Additionally, global demand has been somewhat stronger than expected. Short-term bottlenecks in U.S. shale production growth have also played a role, although we note that U.S. oil production still has grown about 1.3 million barrels per day over the last year, outpacing what we'd expect in a normal year. Some analysts have speculated that U.S. shale's inability to quell the rise in oil prices reveals a fundamental flaw in shale's ability to provide sustainably lower cost oil. We think this reasoning is incorrect. Our team's deep analysis into the two key sides of the shale cost equation, cost per well and production per well, indicate that $55 per barrel is the long-term marginal cost for shale. And therefore, as these short-term issues in global oil markets fade away, we believe oil prices will likewise converge to $55 per barrel, our below consensus long-term oil price forecast.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.